Hi there, Adam Gower here, founder of GowerCrowd and host of the real estate reality show at youtube.com/GowerCrowd and on podcasts everywhere. Welcome to this week's real estate reality show weekly news roundup with my guest, Dave Saxe, managing principal at Calvera Partners. Each week, we look at three of the top stories dominating the news, and this week, we're going to be discussing, number one, the latest Fed rate hike. Number two, continued acceleration of distress in commercial real estate markets. And number three, though not commercial real estate per se, the impact of rate increases on single family home prices. If you'd like to learn more about Dave and Calvera Partners or about real estate syndication and crowdfunding in general, visit the podcast page at GowerCrowd.com. While you're there, be sure to sign up for our newsletter. It goes out every Wednesday. Covers the world of real estate syndication and crowdfunding. It's totally free. You can always unsubscribe. Dave, the latest Fed hike, right, on Wednesday, another 25 basis points, promise of a strong indication of another 25 basis point hike later this year, and little chance of any kind of decrease anytime in the foreseeable future. Boom. What's going on? What's this new? Are we in a new normal yet? Is this a new normal? Are we there yet?
It depends who you ask for, who you read, the forecast that you look at, that I was looking at this morning. This one was expected. As you mentioned, we wrote about this. You've probably written about it, talked about it. Everyone was looking for an indication of whether or not they were going to do another one. It's all conjecture, but it sounds like, the economy has continued to grow. There's debates as to whether or not inflation has been dialed back a bit, if it's enough. Mm-hmm. So personally, I could see them continuing to do this, which impacts our ability and your ability, everyone's ability to underwrite deals, value real estate, and continues to create uncertainty, which markets do not like.
So the big question, though, that I've been reading this week has been kind of the common refrain of, right, is this idea of this being a new normal. But I've also heard the idea that it's actually a normal, right? It's like this whole last, 8 years or so of almost
free
money, right? Free money is not normal, but that this is a new, this is a normal. But the question is, are we there yet? And the fact is that until there is a flushing out of the market, right, it won't reach a stable level. It cannot possibly reach a normalized level of stability until there's a flushing out, right? There's all the maturities that are coming due in the next few months, and there's billions of billions of it. It's just everything I read. It's another few billion, trillion, a billion,
trillions,
billion, whatever it is, gazillions of dollars. And we know that it's coming down the pipe, right? There's no doubt about that. Until that actually flushes through, there cannot be a stable market, right?
Correct. Until, and I read the same things. It's up, the distress is up 6% by property type, depends on the metro. Until all of that distress, depending on the degree, as you said, gets priced into the system, is flushed out, until we see what those things trade for, what those properties trade for, and buyers and sellers can meet at an agreed upon price and a consistent level that we can all look at, and look at all the sales comps that we put into deal summaries. Only then will we have the ability to figure out what things are worth and what we should be bidding.
Well, it's interesting to say, because I remember when I was working at East West Bank, selling notes during the global financial crisis, right? Real estate collateralized non-performing notes. We were in the same position then at the global financial crisis. There was this bid-ask spread. So what is the true value of an asset? That's the challenge that the markets are having at the moment. What is the true value? And the fact is that true value is only what somebody is willing to pay for it. That's the reality of the market.
Right? Yes. And for the first time ever, when we look at deals, buyers are saying, and I'm referring to multifamily here, although it's probably true across the board, they're looking for what's called positive leverage. And for the first time, before, when we used to underwrite multifamily deals, people would assume massive rent growth, and the cap rate that they would pay was less than the interest rate that they were paying the bank. Well, now we're finally seeing, I mean, after many years, buyers such as ourselves saying we need the cap rate to be above the interest rate. We need more predictable cash flow day one to remove some of that uncertainty. Slowly, we're seeing some sellers willing to psychologically accept that, often if they need to. And to your point, until more people do that and flush the true value in the system, the bid-ask spread goes to zero. Only then are we really going to get a sense of where we're at and hopefully where we're going.
Yeah, that's interesting because, again, just kind of going back to this idea of what is normal. So what is normal during this kind of period of flux is that the economics change dramatically, exactly the way that you just described, right? So you've got positive leverage instead of negative leverage. Negative leverage during zero interest rate periods implied people had confidence that there would be growth in rents and that they could outrun that negative leverage. Now, during this period of instability, you cannot afford to be making those kinds of assumptions. So you have to have positive cash. But will the true new normal only become apparent when people do start taking on negative leverage again? Right? In other words, we've gone through this cycle and now we've got confidence coming up.
Yeah, I guess that would be true in that I know the psychology of many buyers out there, and we saw it in the run-up when people were buying at 3 caps and they were programming 10% rent growth annually into their projections. To your point, which is where I think you were going, they had some pretty good confidence that the apartment market was growing, that rents were going up. We could argue on what that percentage annually would be. Now it's readily apparent, us included, it's very confusing out there. It dramatically depends on the market, the submarket, the type of building. We can't even get any certainty right now on, even if we hire an amazing property management firm, can they find somebody who runs the building on site that could even execute what we think is going to happen? There's all insurance, weather, there's all sorts of uncertainty right now that is causing this bid-ask spread to be all over the board.
Well, now that the other aspect of rising interest rates, of course, is from the investor perspective, right? You know, my side of things, of course, is passive investors, accredited investors, or individual investors looking to participate in commercial real estate, but it applies to any kind of passive investor, right? Essentially, the spread between the risk-free rate and the kind of returns that investors want inevitably stays the same. But as rates go up, investors demand increasingly higher returns to match that, right? I mean, it's a fact of how the economy works, right? How people actually make investments. I remember I don't like to admit this very long because it makes me seem really old, but I
won't tell anybody.
in the 1980s, right? When I was first involved in raising capital for real estate, I mean, I'm sure I remember getting 10, 12% on deposit at banks, and that mortgages were in the high teens. And yet the market was efficient. People invested, right? People made money. There was still an opportunity to do it, but the market had stabilized, and that was normal then. Today, as you see interest rates going up, investors need increasing returns and consequently are staying on the sidelines because they're not seeing it, or at least they're not seeing risk-adjusted increase.
We're noticing that too as we talk to accredited investors. So the first time ever, we've been around a while, we have investors, and this is what they tell me in real time, have these conversations all the time. I can put my money under the side and do nothing and earn whatever, 4%, 5%. So we didn't have to, quote unquote, compete with that before. So when we're presenting a real estate deal, to your point, which has a higher and perceived risk, right? It's not a risk-free rate. we have to make a compelling case that it's worth going into that asset class and taking the money off the sidelines. So they do the exact same analysis that you just talked about.
Let me ask you something, actually, because it again just spins me back to I don't know if they were good old days of the 1980s, but I do have this flashback. So preferred returns, the impacts of preferred returns. I actually got a sponsor, a seasoned multifamily sponsor who's been talking to us about helping them with their marketing. And one of the resistance that I have, first of all, is that I only really want to work with people who I think are going to be really successful, right? And who have a track record. So they have
methodology.
So they have a track. Yeah, exactly. Right. So if I'm sure they're going to be successful, I can bask in some of that. So I need to be sure going up first. But here's the thing. Their preferred return is 5%. And I just think, first of all, even during the good time, you were competing against 8s, which was normal, some 10s, and on the low end, 6s. So if you got a 5, when you can get 5% in the bank, basically, does this increase in interest rates impact the decision of what kind of preferred return to pay?
Yes. So even when interest rates first started rising at a fast pace last year, I was hearing in the market myself exactly what you said, that people are starting to see preferred returns go up. Now, taking a step back, it does depend on on the type of investment and the risk of that investment. A preferred return on a development deal is going to be different than a preferred return on an existing, say, apartment asset or even an office asset. It also depends on the business plan of the opportunity. So some of it is math. So if the projected hold period is 10 years versus 7 years, you'll see lower preferred returns because it's a longer period of time. So there are a number of things, but you're 100% correct. Across the board, people look at that.
Yeah, exactly right. So let's move on to our second topic, which is kind of the same. But this was the Commercial Observer.
I'll make it different.
Well, the Commercial Observer put an article out earlier this week. CRE loan distress up 70 of the largest metro areas in June. Oh my goodness! So this is a continuation of the Fed story and the Fed interest, policy story. So what's going on? I mean, is there any? You do see optimists online who, no, it's not that bad. It's going to be okay. Everything's going to be rosy. But are they burying their heads in the sand?
Well, you're talking to someone here that is looking at the downtown San Francisco skyline at the moment at some buildings that have traded recently for valuations that haven't been seen in ages, 30 cents on the dollar, 40 cents on the dollar. So as with other things we talked about, some of this is market specific. So if someone came to me as a Bay Area native here and said, downtown San Francisco has no problem, it's going to recover really quickly, I would say, yes, they have their head in the sand, and we have proof of that, particularly in the office sector. You could make a case in certain markets, though, because valuations have fallen already due to an increase in interest rates, that we're getting a sense of where that's gonna go. But we talked about this on a previous episode. That's why you have lenders trying to, or being encouraged by the federal agencies to work with the borrowers, because they must either, one, they think it's going to recover soon, so give them more time. I'm a little bit more pessimistic, particularly on the office side, in that they don't want a wave of lenders being the owners of this real estate, and neither do the lenders.
Well, this is something I think we discussed before, is this idea of regulators encouraging banks to work with borrowers. But there has to be a point of reckoning, right? You cannot, unless there is total confidence that the market is going to recover, that values are going to recover. And the only thing that can really do that is going to be interest rates. And there's no sign of that. And the Fed's comments this week, there's no sign. In fact, indications that it is a long-term. This is, get used to it. This is not going away anytime soon. What do you think the regulators are they trying to spread out the distress, or Like during the global financial crisis, they called everything to market. It was like, let's get this done fast. It was like a surgical effort.
This is different.
Different.
This is very different. I just saw that there was some proposed legislation, in fact, right on that subject about how they wouldn't make you mark to market in the same way that they did last time, or for lack of a better word, rip the Band-Aid off here. And I do think there's that going on. I'm a little bit more pessimistic in terms of, I think this could last a while. It could be the new normal. So if that's the case, they have to spread it out. Otherwise, we're going to...
Oh, I see.
It's spread it out, particularly in markets like San Francisco. That being said, though, I'm seeing big owners give back office buildings, like Starwood was in the news. It's happening. There is a point by which, yes, it's happening already, where it's going back.
Yes, I saw I forget who it was. I don't know if you can remember. I saw an article this week. Somebody very credible and reputable enough. I wish I had the link here in front of me so I could say it was. Who said, yes, he thinks that, obviously tongue in cheek, he said, yes, a lot of office buildings could well be torn down and turned into lovely inner city parks. It'll be very pretty. He said, it's just very cynical. But are you seeing anything with office not rehabs, adaptive reuse, effective adaptive? I've seen a few articles so far.
Yeah, absolutely. I've seen a few articles on that. I mean, here we're kind of testing this out, our base case for where a lot of that news is coming from. We know here in San Francisco that our downtown does not have enough residential. And what we need to do is something that happened in New York City after 9/11, where I think $20 billion was invested into that market to make it more, for lack of a better word, mixed use, have different things going on. And they're benefiting from that now. Here, absolutely, the city is almost saying, the mayor is saying, come to us, let us know how we can help you do this. But it's really hard, having worked on an office to residential conversion in your neck of the woods in my past life. I wasn't on the development side, but more the asset management investment side, and how hard that is and complicated. And there are a lot of things can go wrong. It's challenging.
Yeah, I worked for a company after I don't want to talk too many names, but I worked for a company after the global financial crisis that bought an office building and converted it into gorgeous residential. And it was really, really difficult to do. Once they started stripping, it was actually an older building, stripping stuff away. One entire side was all asbestos. And that had to be ripped out and added millions to the cost of the
renovation. Exactly right. You're absolutely. That's what I experienced observing it in a previous life. If we experienced that when buying an older apartment building and just opening up a floor where we see it there, now take that to an older office building,
to a 1 million square foot office. Where the only way to
what you're going to find in the wall, or
where the only way to get anything out of the place is by the elevators. That's the other thing about office that makes me think, you've got to move stuff, everything up. Yeah, it's just really difficult, slow, laborious. Everything's got to fit into. I don't know. You can build scaffolding and a lift, external lift, elevators, I suppose, but still very tough.
So we're saying we're going to get more parks. Is what we're saying.
Inner city parks. Yeah, but do you think there will come a point when office will really reach those levels where it becomes economically feasible to convert them?
Even here, and I keep going back to my local example because it's the one that's always in the news. I personally would be really surprised if that happened. I think there's always going to be a need for office. People want to congregate. I'm already seeing it come back in downtown San Francisco. I think I have more concerns, less about the need for that and more about the type of office that's in demand. So could I see a Class C office, low-rise office building in San Francisco not be needed anymore and fall to that value? Potentially. But I think there's always going to be a need for the nice high-rise space to bring investors through, to have people congregate. That'll be there. So
it's interesting you say that, because when you look at some of the values, and some of the articles I've been reading this week talk about office investors, obviously large institutions that have been selling at 50% of what they paid. But here's the thing, they paid for it 10 years ago, what they paid 10 years ago, or less, 8 to 10 years ago. And real estate has this reputation for, if you can survive the long term, if you have a long-term perspective, you're going to be okay. But in these cases, it's not true. There has been a fundamental shift in the way people use offices. But yeah, sure, it may come back, but it's certainly not anything that's going to happen anytime.
Well, I'm seeing, just as a real world example, if I walk into, say, a downtown WeWork space, I know people that work in there, et cetera. The common areas are really full. The flex space, the ability to do what you kind of want. But if you walk around, the offices are vacant. It's what you call a see-through office building.
Yeah. Well, I've actually I wasn't WeWork, but I worked in an incubator. So it was just basically a large open warehouse with desks everywhere. And they had a few staff offices that I thought were just incredibly depressing because they had no exterior windows, just dark and recycled air. I didn't like that at all. But I found that environment, and it was by no means a WeWork type of comfort. I mean, there were sofas and chairs and a snack area and whatever. It was cool. And what was nice about it was I could be having this call with you at my volume now. Nobody would care, right? And no one would care because everybody's at the same volume. I could hear, but I'll tell you something else. I remember getting off a call one time when I was working there. I remember thinking, oh my goodness, I can hear, and some guy way down at the other, I can hear every word he's saying. I know everything.
So I have noticed that the younger folks that sit in the common area, which is the new generation, are exactly like that, where they have no problem talking on the Zooms, and there's no confidentiality, and everyone knows what everyone's working on. I still would go into a booth.
Well, yeah, they did actually install these really cool soundproof telephone type of telephone booths. They were amazing. There was one literally sat next to me, and people would go in there, and I knew they were shouting, but I couldn't hear anything. I mean, it was really soundproof. It's very cool. Yeah, I've often wondered about that. started watching a documentary on WeWork and Adam Newman. We haven't finished it yet, but
there's rumors that there's rumors that once his non-compete ends, which is WeWork non-compete,
going to do it again.
Buy WeWork back for much cents on the dollar.
I'll tell you what's interesting though about that. Let's get off this topic.
Absolutely.
Drill down on this too much. But one of the things that was highlighted, especially at the beginning of that, was that he did not think of himself as a real estate company. Now might be a good time to start thinking that way, because
that's a topic for another time. I mean, oh my goodness. I mean, they just gave back 600 California Street here in San Francisco to the lender because they started buying their own real estate where they were the largest tenant. And speaking of things going back to the lender, that one just did, and they were the owner.
All right, so that is an interesting topic. Let's see how that.
Another time, yeah.
And another time. All right, so on to non-commercial real estate and home values. Now, this is an interesting topic. Robert Shiller predicting flattening of home prices. Why is that? I mean, if with interest rates going, and of course, I have my own opinion, but I'm going to ask you first. Interest rates going from sub threes. My mortgages are all sub threes. It's ridiculous.
Yeah, me too.
Above sixes. Why are home prices, single family home prices, not collapsing?
It's not enough on the market. So if there's no sellers, taking a step back, if even my own parents have said, if I sold my house, well, where would I go? Or anybody? Because what's going to happen is if you sell, you're then going to have to go find a place, and your loan's going to be a lot more expensive than the one you're currently sitting on that could be really beneficial to you for a long time. It is essentially an asset. So if there's not enough product on the market, and not enough being built as well due to rising construction costs or whatever. It's all supply and demand. I'm an economics major. Yes, this vary by market. It varies by market, though, for sure.
Well, to borrow a 1031 exchange term, the up leg when you sell your home is the challenge, right? It's much harder. Even if you want to downsize. You want to downsize and find, you've got your kids have moved out. You don't need 4 bedrooms anymore. You're happy with 2 or something smaller. And you're looking down the barrel of something that is much smaller, but costs the same. So why bother?
Right. No, and even and it does, I will say, it does vary by MSA, but by market across the country. And here in the Bay, particularly in Silicon Valley, you do still have a lot of folks in the technology industry sitting on a lot of cash, and they can still pay big prices because they don't need to rely on that loan. So you'll see just different pockets of things where the statistics probably move a little bit differently, but the Schiller thing is a broader look at it, which is, yeah, that's what's going on.
And this is actually covered in Fortune.
So
it's big news. And I'm actually looking for another house as well, and just cannot believe the price. So I'm in Southern California, Central Coast. As you know, I don't know what it is in San Francisco. We should share some numbers though. So I'm hoping against hope to find exactly what I'm looking at for $500 a foot. I figure that's probably a decent area, for where I am, right? It's probably a decent. Friend of mine just bought a house. He bought it in Madison, Wisconsin. I don't know why she's moving to Madison, Wisconsin. I'm going to go visit her next week and find out the scoop. $200 a foot. Oh my goodness, you're actually kidding me. How do you build for that these days? $200 a foot. They bought a beautiful home. And it's basically paying for this home she's buying as much as I'm looking to put down on a house here in California.
Well, sorry, keep going.
And yet the final point, yet the market is $750. And when I left LA and we were in Beverly Hills, everything was over $1,000 a foot for residential. I'm not sure that there's been any change.
Yeah, no, and I'm saying, but you could probably get a storage locker in San Francisco for $200 a foot in a condo project.
A parking space.
Yeah. Pretty much. I don't even know we get a parking space.
Well, the only thing that I'm seeing that is hitting those numbers is new construction, which is also interesting. And I wonder about a lot of the new construction that especially was institutionally capitalized. So you've got IRR hurdles, the sponsor got IRR hurdles that have been extended dramatically because of COVID and the slowdown. And now how are they going to hit those hurdles and make the kind of, they're just relying on the fees, presumably.
Yeah, no, they're not. One other fascinating kind of impact of all of this, I'm curious to get your take. With the Madison, Wisconsin, everyone's always looking for the new market to invest in. Where's everyone going to go? And sometimes it just seems like people leave the Bay Area and then they go to Austin, and then Austin skyrockets, and then everybody has to leave there and goes to the next. Maybe the next place is Madison, and we just don't know it yet.
Well, I'm not going to Madison. I'm going to Denver to find out. But she sold her house there as well. I forget, it was not much more per foot. Anyways, there's one of the joys of living in California.
Yep.
All right, Dave, absolutely. Super good seeing you. Thanks so much for joining me to do this today. Again,
thanks for having me.
Yeah, sure. There's Dave Saxe, Calvera Partners. If you want to find out more about Dave, go to the podcast page at GowerCrowd.com. I'll put links to his bio, his website, everything that you need there. And while you're there, of course, be sure to subscribe to our newsletter. It's totally free. It goes out every Wednesday, covers the world of real estate, syndication, and crowdfunding in detail. You'll love it. You can always unsubscribe. Thanks so much for joining us. Dave, thanks for joining me today. And thank you, dear viewers, for spending your time with us. In the future, all being well, we'll go live, so you might even be able to join the festivities. Yeah, it's a bit scary, isn't it? Thanks, Dave. Bye for now.
All right. Thank you.